rather than use 100% reserves, because as soon as you say the word reserves in the banking area, you're using the word in ways that are different from normal usage, because they have their own vocabulary. In essence, what we're saying is that credit may not be loaned out. Only money may be loaned out. That's a more accurate description of what we're doing with the American Monetary Act. But Norman is going to discuss how Gesell's ideas fit in with this, and so please give him your attention.
Thank you. It's good to be here, and I hope after all the controversy that we just heard, I'm not going to stir another controversy here since we're at it. So maybe some people or many people have been here for the first or for the other 2 years too, and you remember Silvio Gesell always came up. There were questions of what's this guy, what was he about, what were his ideas, and we had a presentation last year by Guido Preparata. And even after that presentation, I felt like the basic ideas of Silvio Gesell were not really introduced yet. So I hope I can close that gap. But since Stephen gave me only half an hour, there may be still some questions left afterwards. But maybe I'm not bending down so much. I thought maybe good just half an hour. So Silvio Gesell, he was a Argentinian merchant. And he actually was quite successful as a merchant, and he made quite a lot of money, and then he was able to buy himself some time, as Ola put it, and he started to sit down, think, wrote books about the problems that he encountered in his life as a merchant. And he struggled a lot with price levels at this time, 1890 in Argentine, and there was a gold standard. And so he was thinking, why is the price level going up and down 200% sometimes or so? And after, he started publishing his books, and 1916 was when he put out his most acclaimed work, The Natural Economic Order, which we will talk about a little bit later, why it is called natural. So in this time, he was arguing against the gold standard. And he said, right now, money is not avail, so it affects the real economic activity. We have depressions, business cycles, depressions because of the money circulating in the economy, because it's tied to gold and because of other reasons. So, and he said, decouple money from gold. We don't need gold. And anybody can remember yesterday David's talk, Hitson. So everybody who said, in this time we don't want gold as money, they were monetary heretics. They were outcasts. So they were not really regarded well. And so the same thing happened to Silvio Gesell. So the most important thing he's argued is our current economic order is unnatural. And what does he mean by being unnatural? So he compared it to nature and said everything in nature kind of comes and goes, it perishes over time, goods lose in value. And if you look at money, which was tied to gold at that time, that was the only good that just kept its value. You could put it at home, not touch it, and it would stay exactly the same. And because of such, you could hoard money. You could store it at home. Instead of using it in circulation and paying for goods and services, you could hoard it. You would enjoy a so-called liquidity service. You were happy to have the money at home, being liquid all the time, being in the position of buying when you want, instead of having it loaned out to someone else and wait until to get the money back. So he said, if I don't get the interest, if I lend it to someone else, I'll keep it. So I still enjoy that liquidity service. And so money was inherently different than goods and services. And he said, that is unnatural. So we have to put money back onto par with goods and services. As they lose value over time, so should money. Otherwise, they're unequals trying to be exchanged, and money can be withheld from circulation. Goods can't. So you're the producer. You have to sell it in order to regain your money. if you want to create services, so if there's no one else there to buy it, so it cannot be done. So and he said, okay, as a solution, money should rust, should have the same properties on average than goods. So money should be devalued over time. So the money bill that you have in your pocket should lose value over time. So in the 30s, they had some successful monetary experiments that Guido Preparato was talking last year about. So where you had to affix a little stamp on the back of your bill. So 1% of the nominal value, the bill would lose over time. So that was kind of cumbersome at that time. Today, it would be much more easier to implement that, especially if you would extend it to all the electronic deposits and stuff. So technically, today, that is quite feasible. So I don't claim to be as good as Silvio Gesell in actually presenting you the ideas or the basic ideas. And that's why I would encourage you to read the little story that I put in the back of the handouts. It's a little Robinson story where you, after reading that, understand why money gives you a liquidity service and why the interest cannot fall below this liquidity service. So there's a difference in an economy that has no money and an economy where we facilitate our exchanges with money. So, and he contrasts this very well in a little economy with just two people, And I really encourage you to read this to understand what is the essence of Silvio Gesell. Just in case if there are some people who don't have handouts, so I printed about 50, but in order to save one more time the environment, I printed them backsides, and my printer didn't leave one empty page then, so there may be 40 handouts. So I have more copies of the Robinson story in the back if you need that. Also in larger print for those who have problems reading it in the fine print, there are some more copies in the back that you can grab. So let's talk about the problems with non-rusting money. As I said, money is the most liquid asset. When you have money, you can exchange it immediately into everything you want. So that's why it is the most liquid assets. It commands the highest liquidity premium. Most other assets today also have some liquidity premium, but it's not as high as money. So because of this liquidity premium, we can, or because money is hoardable, that means you can store it at little or no cost. You want to probably have it at home because of its liquidity premium. If you have no service from having money at home, you could go invest it somewhere, earn some real interest. You don't because you have some non-monetary service, which is the liquidity premium. That assurance, I can spend it whenever I want it. It's a non-monetary service, but still it's some service that you get, and there must be some reason why you don't give the money to someone else and earn real dollars on it. So there's one concept that is not very often mentioned. Liquidity premiums are paid by those who take out loans. So the company that goes to a bank and asks for a loan, they get $100,000 in loan and they pay a liquidity premium on that. But as soon as they have the money, they go and spend it. So they don't after that, they don't have the money anymore, but they're still paying the liquidity premium. So there's a disconnect between paying for something and someone else is enjoying the liquidity service. And whenever you have something like that in the economy, so there you have some external effects. So there may be some misallocations of capital because of that. So it's always a problem in economics that we discuss when there's something like that. Liquidity premiums, I always ask myself in the last year, so is this a problem? So I consider them, they've gotten very small over time. And after August 2007 passed, I realized, yeah, most of the time they've probably gotten very small because we have many assets that also pay liquidity services. But when you have a confidence crisis, your insurance against this uncertainty is holding as much liquidity as possible. So in August, suddenly our liquidity premium in the markets went up drastically. Instead of maybe 20 basis points or 2.2% of an interest, it suddenly was 1 or 2% maybe, just a liquidity premium attacked to interest loans. So liquidity premiums are varying over time, so it's not something fixed, so it varies over time. And this is the problem why a monetary economy where you have money with liquidity premiums that are not taxed away can cause business cycles and recession. So this is the problem right now. We are in a liquidity crunch right now. Banks loaned out or went to the bank, wanted money, and they didn't lend it to someone else because it was for them an assurance. They needed the money because they were not sure, are we going to get back our asset-backed commercial papers or so. So they were sitting on the liquidity and were not lending it out to someone else. So and the problem is now, are we going, or is this liquidity crisis spilling over to the real economy? If yes, then we have a problem. That's why Bernanke was flooding the economy with lots of liquidity because banks were not handing out loans anymore. Quite counterintuitive to that what we are thinking. Another problem with non-resting money is you have basically a zero level. Interest rates cannot go below zero. So that can be a problem sometimes. In early 2000, there was a problem that you wanted to be sometimes below zero. That was impossible. So if you tax liquidity, basically you have a lower level. You can reach any interest level, even negative interest rates in the capital markets if you have that. So, and as I said, interest rates can never be negative. They can never be below the liquidity premium. So we have positive interest rates then, and that creates problems. So here is a very strong connection between the points AMI and the Gesell positions. With positive interest rates, if you lend or create money at positive interest rates, you basically have a necessity to grow in the economy. So, and we cannot grow exponentially forever in a finite world with finite resources. This is impossible. It creates ecological problems. We have this exponentially growing debt that cannot be served by real economic assets anymore, so we have debt cancellation. So some of the problems, bankruptcies, for instance, those debt cancellations can also be achieved through war, as has been mentioned here before. There's one aspect with positive interest rates, it's a redistribution effect. So poorer people are always paying interest for the rich people. So even if you don't take out a loan, you're always paying some interest money in the goods and services that you're purchasing. So in everything there are some interest costs. And there have been some economic estimates. It's about somewhere between, you see the range, between $500,000 and $1 million, where you break even, where you actually get more interest than what you actually pay, directly or indirectly. So it's a big distributional effect, positive interest rates. So the Gesell solution is we want to achieve tax the liquidity premium away. So we create an economic system where it's possible for interest rates to fall down to zero. We don't know whether this is going to happen, but we would create an economy where it's possible. Right now, it's not possible. The lower level is the liquidity premium. So what would happen if we tax liquidity? People wouldn't want to hold their liquid assets, so they freely lend it to other people. Instead of incurring a loss, they say, okay, then I'm going to lend it to someone else, so I give it up for a longer period of time. So I basically shift long-term or short-term funds, the funds that I have available for short term and give it up for longer term for someone else. So the effect that this has is it flattens the yield curve. So I'm going through this very quickly. So a yield curve is the interest rates on different maturities. So normally it's the black curve, it's upward sloping. So you're basically want to reimburse for giving up for a longer time, you demand more interest. So that's why the yield curve is normally upward sloping. Sometimes you have an inverted yield curve. It's unusual. We had this for quite a while. It's back to normal. And there's also a flat yield curve. So in a Gesellian system, you would know that you hit the right level in taxation when your normal yield curve, on average, becomes flat. Then you've taxed away the liquidity premium on all those different financial assets. So when you have a flat yield curve, all the assets, different maturities kind of yield the same, then you've hit the right target. So we are shifting long or short-term funds to long-term funds, with an effect that the long-term yields come down, which I just said, so it flattens. So and over time, if you do that over several years, the theory goes that flat yield curve should shift downwards. So you're producing and producing, there's no economic depression anymore, monetary induced. So over time, capital goods should become abundant and our yield curve should shift downward. So step one, you introduce the liquidity tax, it becomes flat. Step two, the yield curve shifts downwards, hopefully to around zero. So that's the idea of Gesell. In order for that to happen, you have to make sure that people can satisfy their desire for liquidity. So you have to offer them the opportunity when they're in a financial bind, they need liquidity, that they can get it. So if there are more long-term funds available, maybe they can go and get them from the financial markets. There may also be maybe a commitment by the bank to provide them with this liquidity. So and that's maybe the relevance for today. So if you have a confidence crisis right now, it wouldn't cause a crisis, or it wouldn't cause a liquidity crisis, because you have that option of potential liquidity. You can get it whenever you need it. So if there are no liquidity crises, it cannot spill into the real economy. So the liquidity holdings are stabilized, and so is the velocity of money. So with actually taxing money that you have in your pocket, you're kind of stabilizing, making it steady, so people do not hoard it and bring it back to economy. So the velocity is much more stable over time. And all the economic theories who assume a stable velocity of money would be valid again. So now I'm coming to the point where I compare the AMI system and the Gesell system, and I want to make a little excursus and define an exogenous monetary system and an endogenous monetary system. In an exogenous monetary system, you look at the quantity of money, and this is somehow given from the outside. It's not determined within the system, and for instance, the gold standard is a quasi-exogenous system. You could argue it's kind of endogenous because, you know, the gold production could be increased over time. But the 100% money, that's a system where it's completely determined by the monetary authority, how much money do we want to introduce, and the actions of all the other actors in the economy do not affect anymore the quantity of money. So that's the perfect exogenous monetary system. Contrary to that, we are living today in a world where we have an endogenous monetary system. The central bank may have an idea of what quantity they want, but whether they get there, they don't know. So they set interest rates, and then you have all the interaction of people who save and people who want to take out loans. And so after several rounds, then they get some amount of money. So the amount of money is completely determined within the system, and it cannot be perfectly controlled. So we have some big instability here. And 2 points are worth mentioning here. In an exogenous monetary system, you have always, or there's no such thing as forced savings. Oh no, there are forced savings. No, actually, only voluntary systems in the exogenous system. So people see the interest rates, decide how much to save, and then people who want to take out loans, they can get these loans. And in an endogenous monetary system, you have kind of forced savings. So it's simultaneously determined by the people who want to take out loans and people who save. So you cannot. And that system is actually determined or described in Rolf Koch. That's a German Bundesbanker from the 1970s. I'm not sure whether you're familiar with him. So he describes how this is possible. That you cannot say you have to save first and then invest, which you can say in the exogenous monetary system. In an endogenous monetary system as we live today, it's simultaneously developed. So we probably should discuss this in more detail afterwards. Now is the question, so are the two reforms, the Gesellian solution, where you impose a liquidity tax, and the 100% money, are they complements or substitutes? Are they addressing the same problem? So we looked at the problem and say, we agree, yes, there's a problem at positive interest rates. So we seem to have different solutions here. So if you look at some proponents, Irving Fisher, who first endorsed the stamp grip solution, which was a Gesellian concept in the early 30s. So he was a Gesellian at that time. 2 years later, so he put out his 100% plan, which was derived from the Chicago School. So suddenly he was a 100% banker. So did he abandon his former Gesellian views? I don't know. I don't think so. So maybe you can hold these views at the same time. So let's see. I probably should go back, but I haven't heard anything that he formally abandoned his Gesellian views and switched over. So let's see how compatible they are. Let's look at Gesell's idea again. So he developed his ideas in his 1890s when he was on a gold standard. So there was an exogenous monetary system. And the way he imagined how money should be introduced in the economy is very much like what Stephen is suggesting. So he instituted, or there's a Reichswährungsbehörde, and that authority completely controlled the quantity of money. So he did not talk about the credit lending cycle, and so he was not aware of it really at that time, so he did not address this issue. But implicitly, he was assuming a system. This is very much like the 100% money. So that was, since it was implicitly never openly talked about it, where he contrasted the two systems, I think most modern Gesellians have forgotten that the Gesellian system was developed with the assumption of a 100% money backing. So now I want to talk about, so here comes the controversy. So now I want to talk about some problems with the 100% money, and yes, also some problems with the Gesell solution. Advantage of 100% money is you create money without interest attached to it. So no interest there. We don't want interest rates, to spur economic activity. But in my opinion, the big backdraw of the 100% money solution is that it's not very well suited to finance rapid economic expansions. After war, for instance, I think the German Wirtschaftswunder, the economic miracle after the Second World War, would not have been possible in a 100% money. The reason for that is there are no forced savings in this system. So people have to decide first, I want to save this much, and then someone else comes and takes this out. There was nothing to be saved from. Everything was destroyed. So in an endogenous system, people or the investors kind of cheat out the savers from, after years they say, oh, I didn't want to save that much, So that's problem in an endogenous monetary system. So if you only have voluntary savings and you want to be compensating for giving up money and lending it for someone else, you have the problem that the yield curve probably steepens very much. For giving it up 1 year, you want more interest. For giving up 2 years, you want even more interest. So I think while you solve the problem, how to create money, you create another problem in the private markets where people compete for funds, and as a result, the yield curve steepens very much. So the money with which you finance long-term investments becomes very expensive. I think that's the biggest problem for the 100% money system. So and now let's look at a liquidity tax in an endogenous monetary system. If we would impose a liquidity tax in our today's system, so that would not address the problem how you create money. It would be still the credit creation process, but you would have neutralized liquidity premium. That itself flattens the yield curve. So over time, I said the yield curve should shift downward. So, and as interest rates become very close to zero, we encounter the problem with the liquidity tax in an endogenous system. This is exactly what happened 2000 and the years after, where we had interest rates of 1% or so. That brought up all these excessive capitalistic traits that are negative, that brought on the current crisis, the subprime mess, cheap credit. So people leveraged buyouts, that's what LBO stands for. So where a company goes to a bank, borrows money, gets the money from the bank for cheap interest, buys another company, sells it for more, that's a leveraged buyout. So if you have very cheap money, cheap credit, you have all these asset bubbles developing. So that's all associated with cheap money, cheap credit, the way money is created. So now we're thinking, this is the problem for a Gesellian system where we want to go to. Low interest rates would bring up all these negative problems that I just experienced in the markets. So now you probably see the solution to the two negative effects here. So one system has the effect of steepening the yield curve, the other system without 100% of flattening. So let's combine the two things. So you have addressed the interest problem at the level of creation of money, and then with the liquidity tax you address the interest problem, what's going on later in the private markets. So I think the two monetary systems cannot stand alone, they have to be merged together, and I'm not sure whether you are aware of it or not, that problem that I meant with the forced savings and the steep yield curve, and that there is no substitution from short-term to long-term. I think this is the killing argument for most people who hear about it. When they say, there is no maturity transformation. You cannot create money by transforming a short-term asset into a long-term asset. Then they stop thinking about it. So I think one solution is to say, it's fraudulent what's going on, we don't want it. I think another solution would be to say, okay, that may be a problem in a very young economy where you have the need for rapid economic growth, but we are now in a mature economy, so the problem is not as big, and we can address it with a liquidity tax. But I think we need a double monetary reform. The one cannot go without the other. So thank you.